The retail industry is looking like a real stink storm. Looking at Walmart's down around 8% today following their weak earnings outlook, sending effectively a warning about the state of the American consumer, talking about the increasing level of food and fuel inflation affecting how customers are spending. This is not surprising. We've talked about this for quite some time now, several months on the Unrivaled Investing channel. You can look back across several of the videos. Customers have to make a trade-off. And so when you have, high food, high fuel, higher shelter expenses, everything else comes under pressure. And that's exactly what Walmart is seeing. They're talking about having to clearing hardline categories. That means creating greater discounts for hard goods like furniture, appliances, tools. And they're also now anticipating more pressure on general merchandise in the back half. So looking at the second half of 2022, saying, yeah, we're facing even more pressure because of this inflation. So this is really important for investors to consider. This translates into even weaker outlook for the year, talking about a decline in operating earnings of 10 to 12% and looking at a decline in adjusted earnings per share of around 10 to 12%. This really, in my opinion, has me concerned because the first step of this market decline, about 20% decline in the S&P 500 so far, has been primarily from valuations reacting to higher interest rates. You have, let's say, the 10-year treasury go from 1.5% to around 3%. That is enough to drive a 20% drop in the S&P 500. That's pretty much how the math works, given how low interest rates were and what it implies for underlying equity valuations. The next key component is, hey, what happens if you have higher inflation impacting underlying profitability? So you've seen the decline because of the initial valuation impact because of higher interest rates. The next potential shoe to drop is the earnings compression. That is what you're starting to see now with companies like Walmart say, oh yeah, this outlook for this next year, yeah, we're now expecting to decline by 10%. So in that situation, yeah, that 20% drop in the stock price doesn't really capture what you really need to bake in because it's, oh, okay, not only do you have higher interest rates that affect the valuation, now you need to consider the fundamentals. And if the fundamentals are now, deteriorating to the tune of 10%, like you're seeing here, that does warrant, a lower valuation, at least for a lot of folks to think about it. The third component is then when you see these things starting to feed off each other, you can sort of really get a vicious cycle downwards. And that's the concern that has me, sort of on alert, seeing a company like Walmart targeting, a 10% drop. Looking on the online retail side, so Walmart's primarily offline. Look at the online side, Shopify enabling, billions and billions of dollars of online commerce, down 15% today, as well as they announced that they will be cutting about 10% of their staff, about 1,000 jobs of the total of 10,000 jobs. And so, this is a big drop, seeing around 15%. This was previously one of Wall Street's favorite stocks. I own a little bit of Shopify stock. Toby Lutke, founder and CEO of Shopify, talking about how effectively Shopify has always been a company that makes the big strategic bets our merchants demand of us. And he's saying, we bet that the channel mix, the share of dollars that travel through e-commerce rather than physical retail, would permanently leap ahead by 5 or even 10 years. This was in response to COVID. And effectively saying, yeah, we would have to expand the company to match. So because of that sort of jump in demand in online sales because of COVID, he was saying, yeah, I expected this to be a permanent shift higher and sort of leaping ahead. So that way, maybe by now we would be closer to 20%. Okay, so let's explain this chart. So this shows U.S. e-commerce adoption as a percentage of addressable retail over time. And you see, this is a nice secular trend over time. This is early years. This is Amazon growing, taking a lot of share from retail, going from effectively nothing to around 5% of total retail by 2010. Now it continues to grow. And you saw this huge uptick because of COVID. And really, it's actually been sort of stagnating since then. There was this sort of peak of around between 15 and 20%, during peak COVID. And now it's sort of been trending downward. Well, Toby Lutke, founder of Shopify, he was expecting, oh yeah, this is where it's going to start. And then you sort of have a reset. So that way by now you're looking at 20% plus. We're not there yet. We're still close to 15%. It's sort of society readjusting. And because of that, he hired for that expectation that effectively demand would be better than it is. And it isn't. That's really the key concern here, is that demand isn't as good as he expected. And this is once again, if you have higher inflation, this has huge impacts on the consumer. How are they going to, what are they going to spend things on? And when you think about e-commerce, a lot of e-commerce is, comes effectively down to discretionary purchases. It's not necessarily the food, the fuel, the shelter that you're looking at that's the core drivers of inflation that's hurting a lot of folks right now. It's the discretionary, like, hey, I really want this little widget spinner thing that looks really fun, and or it's something goofy. There's a lot of discretionary purchases that really come under the gun in this type of environment. It's going to put a lot of pressure, and that's, I think, what he's talking about here, is that you have sort of this reset and things didn't grow as fast as he expected. So when is the time to start buying? Because I mentioned that, I do have a small position in Shopify, but I haven't made it a huge position yet. Well, first, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. So Shopify is set to announce their earnings tomorrow. So there will be more detail tomorrow. But right now, announcing effectively this layoff the day before certainly does suggest that things were weaker than they expected. And so I think you should expect to see a weak quarter tomorrow. Maybe that's now getting priced in, given that the stock dropped 15%. Last quarter, they grew about 22%, and they were still unprofitable. So this is still in one of those companies that needs to prove out their profitability. Now, yes, 2021 was a strong year where they did get to around 10% margins, but I think investors want to see, hey, are you actually a sustainable free cash flow business? I mean, that's what capitalism is all about. If you're going to be putting money at risk, am I getting money back as a shareholder with either dividends or buybacks or some sort of free cash flow, some sort of value being rewarded other than just doing sales at an unprofitable level? So in this market, which is a broader risk-off market because you're facing a tougher economy, you're facing, tougher valuation pressures because of higher interest rates, you're looking at a situation with certainly, a lack of central banker support, which a lot of investors really aren't used to, because this is the first time in 40 years that you're in this sort of environment. And so I think a lot of folks are waking up saying, yeah, this is still in this pile where they need to prove themselves. Looking at this core profitability, effectively a loss of $100 million in the first quarter, and I would expect their growth rate's going to be significantly lower than that 22% in the next quarter, when they report tomorrow. So we'll see. I think I'm still seeing, even though sentiment is quite negative, I'm still seeing and hearing a lot of FOMO, and FOMO stands for that fear of missing out. Let me elaborate. When I talk to various different investors, I'm still seeing this sort of well, I want to buy Shopify because, I don't want to miss the bottom. I see that, I hear that type of thing, hey, well, once the bottom happens, then it's just going to rip higher and I'm never going to see that again. But the reality is, if you find these great companies, these great, unrivaled companies that you can just sort of sit on for years and years and years, you don't need to get the exact bottom. You can wait until you see that the execution's there. Yeah, maybe you don't get the exact bottom by 50%. Maybe you miss it by 100%. That's fine. If you find something that's oh yeah, this is clearly going to keep compounding, and I see that all these concerns and pressures are starting to alleviate, that's, in my opinion, that's fine. Especially because if you find that type of situation that can go up 10, 20x over time, even if you miss that first 50%, buying after, I'm perfectly fine waiting to see how much further pain you could have, especially because we're in this environment where there's no central banker support. So I still see a lot of this sort of FOMO, still see this buy the dip mentality. And I'm not so sure that folks are actually keeping their eyes open to the reality that we are in a very different period than what we've been in over the last 40 years. And what's worked over the last 40 years may not work now. And I think that's really important for investors to consider. As I think about a hypothetical valuation framework for Shopify around $30 a share, sub 40, around $40 billion market cap, I'm thinking about growth rate this year. Maybe it comes in a bit lower. We'll see how bad their second quarter is. I'm penciling out 20 to 25% growth rate. Their growth rate in the first quarter was around 22%. So maybe this is too aggressive. We'll see. I'm saying long-term, their profit margins, nowhere near this right now, get to around 20% as well. Slap on a 20% tax rate to think about what could their earnings possibly be, now if they were to be at these margins. And then think about what's their growth rate in the years ahead. And it's certainly tough for investors to say, well, wait a second, if you're only growing at, let's say, 20% this year, why should your growth rate reaccelerate to 30%? But I think that's important to understand is that, stocks are volatile, businesses are volatile. It's not always necessarily a linear path up or down. So I'm penciling out a range over the next 5 years of about 20 to 30% annualized growth. If it comes in significantly lower than that of, let's say, a teens growth rate, then I think Shopify stock will be in a world of pain, even if, even looking at the current stock price around $30 a share. So I'm effectively saying, hey, this is sort of, what am I penciling out for the upside? How can investors get rewarded? What are sort of the underlying assumptions? So assuming 20 to 30% growth on an annual basis, which is an acceleration from where they were last quarter, assuming their profit margins, they get to significant profit margins, which they're nowhere near. And then assuming that they get around a 20 times, 25 times earnings multiple, you could say that's too rich. You could say that's, too cheap. I personally think this is on the richer side, especially given the environment that we're in. So looking at the current stock price around $30 a share, I think it's closer to 32 right now. I'm saying this is all right. I'm not saying it's crazy compelling. Now you might say, well, Daniel, I think you're way underestimating what their growth potential is over the next 5 years. So if you're a mega bull on Shopify, I think you have to be able to say with a very straight face, 30% plus growth. So a significant acceleration from here, a significant, earnings multiple, let's say 5 years from now, close to 30 times earnings. And you have to assume a profit margin that they're nowhere near currently achieving, let's say in the low 20s. That's just those three things. That's just to get 100% plus upside from here. So I do own sort of a teaser position in Shopify. I think I'd want to see it quite a bit lower personally before I'd start making it a bigger bet, just based on me trying to have conservative assumptions, saying, hey, they're currently growing around 22% in the last quarter. This current quarter, I suspect, is going to be lower given, hey, you're now laying off 10% of your workforce. So maybe 20% is the better number to sort of anchor on or focus on. And given that, what's the right end multiple? I would want to see a much higher sort of upside potential here, because right now I'm sort of saying based on a more conservative framework, you're effectively flat or down slightly over the next 5 years with upside of 100% potential. I think there are probably better bets out there. Once again, this is not investment advice. Of course, stock price can go way higher, way lower. A lot depends on the underlying, business of Shopify. I think honestly, it would be pretty shocking if they reported a huge acceleration in growth the day after they announced a 10% cutback in terms of their employees. So I'm looking at this saying, maybe that's starting to get priced in with Shopify. Maybe you get some sort of dead cat bounce with this sort of thing. But until you start seeing meaningful profit margin, heading in the right direction, and also ideally, management saying, yeah, we believe we're on this track for, let's say, 30% growth in the years ahead, that would probably get me to go, oh, okay, now I could, get comfortable, at least at the current price. At the current price, I think you need to have around that 30% growth to get a really compelling return. And I'm just not sure you're going to get that in this environment, this tough retail environment where consumers are coming under pressure. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.